Hey everyone, it's Linda in Belize. I'm here today with Mike Pine to talk about US taxes. I'm a Canadian CPA, but I don't really know all that much about US tax, and lots of my clients are Americans that are buying property in Belize or just living in Belize. So thanks, Mike, for joining us. First, can you talk a little bit about yourself and your firm?
Sure. I have been a CPA since the year 2000, so it's easy for me to track how long I've been doing this. It's 2024. I've been doing this for 24 years. I started off in the Big Four, PricewaterhouseCoopers, the biggest firm at the time, and probably still the biggest firm in the country, in their very specialized tax group in the Silicon Valley called their Venture Capital and Private Equity Group. Um, it was an amazing experience. I got to, right out of college, start working on billion-dollar venture capital funds, meeting with really important people like Vanud Khosla of Kleiner Perkins. And after 4 years there, I learned the ins and outs of partnership tax, the coolest things you can do with it. It's still one of my favorite areas in tax, but I still didn't know how to do my own tax return after 4 years at this place, because it's very different. Partnership taxes versus individual taxes. And I knew at the partnership level, we were coming up with great tax strategies and passing them on to their investors of these VC firms in their K1s. But I had no idea if people were actually using it and how it actually fit with saving individuals, the investors, taxes on their tax returns. So after almost 5 years, I left PwC to find a smaller firm where I could actually work with individuals who were paying tax. And I moved here to Dallas. In DFW, Texas. And I learned to work on really small individual tax returns. I'm talking just one graduate level above H&R Block stuff. But it was cool. I got to see that's where everyone pays taxes. I mean, you have corporations, big corporations pay some taxes when they don't have really good tax planning. But generally, out of all businesses, all the small businesses, the taxes are paid at the individual income tax level, our person's Form 1040. And I got to see how that all worked. And I got to see that most people weren't using the tax code for their advantage. They were just using it to comply and stay out of jail. And at this firm, one of the things that attracted me to it, the one I moved to in Texas, they kept saying, we proactively do tax planning with our clients, not after the fact, but proactive with our clients doing tax planning. I found out a lot of firms say that. But at that firm, we were too busy doing tax returns, too understaffed, didn't have enough capacity. There was no time to be proactive about anything. Everything was way right up to the last minute, and we were just lucky to get the tax returns filed by the 15th of whenever they were due. So after doing that for another almost 5 years, I started my own practice where I was going to be a tax planning advocate for clients and be proactive and not just get stuck like every other firm I'd been at doing compliance. And it was a hard slog because tax returns take a lot of time to prepare. There's not much value in a tax return preparation, but to do them right and to keep clients out of jail and to make sure their tax positions are right, that takes the most time out of any CPA's practice. And there was very little time to actually do proactive tax planning. So me being the wonderful entrepreneur that I was, really just focused on tax and not business, I said, all right, well, let's just hire 3 times as many people and build up the capacity so we could do tax planning. So it took almost a decade before I made my first profit, because that's where all the profit went to, was hiring people. But over over the last 8 or so years, we've really kind of refined that approach. And we do have proactive tax planning. It's hard to do between January and April 15th. That's our tax filing season here in the US. We are really focused on compliance, but we like to use the tax code to help our clients leverage it to grow their financial freedom. And ultimately, that's what the tax code is here for. So the tax law in the United States is written by Congress. We elect Congress, the people of the US elect Congress to do something good for this country and hopefully the world. And they've come together and built this tax law framework, the Internal Revenue Code, where less than 1/2 of 1% of all the thousands of pages of this tax law, less than 1/2 of 1% actually deal with the assessment of taxes or the levying of taxes, where the 99.5+% deals with incentives that our society has come together and say, this is what our country needs to have economic security, to have economic growth, to do the things we want to do, to create more affordable housing. There's tons in the tax code that offer incentives for people building real estate for that purpose. Most CPAs don't use that, again, because most CPAs are super busy just getting tax returns filed. I see the tax code, the Internal Revenue Code, and sorry if it sounds silly, but I really believe this. It is like the yellow brick road to financial freedom, just like the yellow brick road in Wizard of Oz was to help Dorothy get back home. The tax code offers a great path if you use it, if you leverage it to build your financial freedom, to make your ROI on any tax advantage investment be twice as high as it would be otherwise. And this is what our practice is trying to help clients do. And this is what we talk about on our podcast at Hidden Money. So that's kind of what our firm is. We're not perfect at it. Good Lord, we still have taxes to file, unfortunately. If we could just focus on tax planning, we'd be a lot better. But we have to file those tax returns too. So that's an elevator speech of mine about our firm today.
Fantastic. Thank you. So one other thing I want to tell viewers is that even though we're talking about tax today, this is general information. Mike, obviously you don't know everybody's individual situation and everyone's is different. So this is meant to just be sort of a high level view of different types of situations that I've seen for people buying property in Belize or elsewhere. And so first of all, that's just the disclaimer. But then the first thing to talk about is just for real estate investors. If they're buying property in the US, or if they're buying property in a foreign place like Belize, in general, how does tax work for that?
So generally, again, from the US, and like you said, this is general tax advice. Please don't use it as your own personal tax advice, because you could have three individuals with the same type of investment in real estate, but because of everything else going on in their lives, it's treated completely differently on their tax return. So again, general advice. Real estate is a wonderful investment when it comes to the tax world. And there's this thing called depreciation. And the IRS says if we ever buy an asset that we're going to use in a business and it has a useful life of more than 1 year, you can't expense it. You can't get a tax deduction for every dollar you spend on it. You have to do something what's called capitalizing it, meaning you treat it as an asset, you put it on your balance sheet instead of an expense. And then you can depreciate it, take a little bit of expense from that total price over the life of the useful life of that asset. For instance, to make it easy, a taxi cab. The IRS says a vehicle has a useful life of 5 years. If I go buy a taxi cab and that's my new job, line of business, and I place it in service, let's say I spend $10,000 on it. The IRS says it has a useful life of 5 years, meaning, and again, I'm oversimplifying it, but meaning I get about $2,000 a year in a deduction for 5 years. I get to depreciate it over 5 years. And we know with most assets, like cars, computers, most assets, they do go down in value over the life of their asset. Real estate's this beautiful other animal. Real estate, you still get to take depreciation for. You get this deduction for your purchase price of real estate over time, sometimes really quickly, but you get this deduction. At the same time, real estate's actually going up in value. So you get a magical tax-only deduction while your asset is increasing in value and hopefully cash flowing as well. So again, sorry, I went into too much detail and specifics.
That's okay.
It is depreciation that makes, and the carve outs in the tax code that incentivize real estate development, but it makes real estate a wonderful tax advantaged investment. If you have a rental property and you own it, as you're operating, you have to figure out what your net income is each year. And you report that either on your taxes, or if you create a company, on the company's taxes. 9 times out of 10, it rolls back into your tax return when you pay taxes on any net income. So you take all your income minus all your expenses, and then on a tax return minus depreciation, a fake kind of expense, but very real in the tax code. And then if you have any income left over, that's your taxable income, and you would pay taxes on it at your income tax rates. Or if you have a lot of extra depreciation, it's a net loss, you don't pay any taxes. And then there are even some situations where you can take that net loss, paper loss from your real estate, move it over to all the rest of your income on your tax return and reduce your income. If you have a W-2 and you can reduce your W-2 income by this phantom depreciation, you get more income tax, more of a refund back from your W-2 job because of this beautiful asset you have that's going down in value on your tax return, but going up in value in real life.
Wonderful. And then if someone had a foreign investment, the one thing I like to tell people about is both in Canada and in the US, we pay tax on worldwide income. And
Yeah.
this is a thing a lot of people don't think about. And I hear a lot of people saying, oh, this country's great because there's no tax on capital gains or no tax on real estate investment or whatever it is. It doesn't really matter. If you're a US citizen, can you just talk briefly about what you do with so you have a real estate investment property in Belize? What do you do on the US side? So you would pay whatever tax in Belize you have to. What do you then do on the US tax return?
So, like you said, we are taxed on our worldwide income. If you're a U.S. taxpayer, either a citizen or a legal resident, and you're required to pay tax on every dollar of income you make, whether it's in the U.S. or whether it's in Antarctica. It's your worldwide income. So you would report that income. If you have net income on a rental property you have in Belize, you pay your Belizean tax, whatever those are, and then you report all that income, 100% of it, on your personal tax return, but you report it as earned in a foreign country.
Right.
Then what you do is decide how much tax at your specific tax rates, at your tax situation, how much tax would you have to pay on that if it was US income? And that's your original tax. But then you get this thing called a foreign tax credit. Any taxes you pay on foreign income, you get a credit, a dollar for dollar credit on your taxes. And tax credit is basically like a rebate or something of taxes. It's like you have a credit of prepaid taxes, basically. So let's say I got $1,000 of income in Belize. I know this isn't right in Belizean tax, but just to make it easy so I can do this in my head, Linda,
Yeah.
you paid $100 of Belizean tax.
Yeah.
And then I go on my US tax return and report, yeah, I had $1,000 of income. Well, let's say the US says, well, on that $1,000, you owe $200 in tax. Well, that's your starting point. Then you take your foreign tax credit of the $100, so you get credit for that, and then you just pay the difference. And in most cases, when you're in a low tax jurisdiction like Belize, you'll still pay tax. You won't have a net out. Like we have some people that have businesses in Britain or in
Mm.
Canada, and sometimes those taxes are higher than the US
Yeah.
tax. So you report all this income, it looks like you're going to owe a bunch of tax in the US, but then you take in your foreign taxes paid, and you don't owe any tax on it. So
Right.
that's how it generally works.
Right. And so just to talk generally about Belize, rental income's taxed on the gross income, usually at 1.75%. So there aren't any deductions. So that's a simple tax to calculate. Whatever your income is, you just multiply it by the rate. And then obviously in the US, you would put all the income in, but then you would track all your deductions for your US taxes. So that's a good point to note. Next topic for tax is capital gains. So you already talked about depreciation of a property, of course, but it's went up in value. Now, I know Canada capital gains rules really well. I don't really know how it works in the US, but in Belize, a lot of realtors talk about the fact that Belize is great because we don't have capital gains tax in Belize. Unfortunately, in Canada and the US, we do. So again, can you talk maybe about the capital gains tax in the US? Because if you are a US taxpayer, and your property in Belize goes up, you still have to pay that capital gains tax in the US.
Correct. So again, it's your worldwide income. You report in the US, if you're a US taxpayer, you report your capital gains from all around the world, all of your income. But capital gains in the US, just like I believe in Canada, we have different tax treatment, generally favorable rates. And again, this is because our society thinks, hey, it's important to get people to invest in new business because that drives our economy. And if they invest in it, they're doing it to hope to get gains. And we want to incentivize that by giving them a lower tax rate on capital gains. So you're eligible for the lower tax rate. And if you don't make a lot of income, that tax rate is zero. So you're going to pay anywhere from 0% all the way up to 23.8% on capital gains. Because there's no capital gains tax in Belize, you don't have any tax credit on it. So in a worst case scenario, you're going to pay 23.8% of all of your gain. But one thing I see a lot of mistakes that people make when they're reporting a capital gain, especially in a business or a rental property, which is a business. Everything they spent to build that business becomes their cost of that asset. So when they sell it, they take their proceeds minus their total cost. More often than not, people leave out a lot of their cost. You painted that house, that's an additional cost that goes into the basis. You had repairs done on that house. If you didn't deduct them, that's an additional cost. So you need to make sure you have all of your tax basis, all of your costs of the asset, but you will pay tax on it in the US, all things remaining equal. There's a lot of mitigation ways and strategies that you can mitigate those taxes or minimize them, sometimes even eliminate them. But generally speaking, you're going to pay your capital gains tax on the sale in the US, even though you didn't owe any tax in Belize.
Wonderful. And that leads us in talking about the tax planning on maybe a way you can avoid capital gains tax is replacement property rules. So unfortunately for real estate in Canada, we don't have this opportunity. If I sell a rental property, I have to pay capital gains tax. There's no exemption. But I know in the US, I have some clients that are accountants that have told me, hey, I sold one of my rental properties in the US and I had certain rules to follow so that I could defer that capital gain because I bought a new rental property. And that's all I know about it. But if you could maybe talk a little bit about that as well.
Yeah. So again, this is another incentive in the tax code that is supposed to help entrepreneurs and business owners grow their business to help out our economy. Let's go back to the taxi cab example. So I started my taxi business. I bought a 10,000 cab. I'm not getting lots of great fares because it's a $10,000 car. As I grow my business and accumulate more resources, I want to upgrade it. I want to get a new car. And even if let's say it's 3 years later, I want to get a new cab. So I go and I do a trade-in and get a $50,000 vehicle. Well, if we didn't have like-kind exchanges, if I traded in that car, I sold it basically for some kind of consideration. So I would have to recognize a gain. That's not really fair to businesses because he's not selling it to cash out. He's selling it to upgrade. And if he had to pay tax on that, or if the taxi cab driver had to pay tax on that, that takes money away from my business and reduces my ability to grow by buying a new car. Instead of getting a $50,000, I'm gonna have to get a $40,000 car. So they came out with these like-kind exchange rules that have been around forever, well before I started in the business. Like-kind exchanges apply to any asset used in a trade or business. You can't do a like-kind exchange on your personal house or on my personal vehicle. If I sell my personal vehicle for a gain, I have to claim tax on it or capital gains tax on it and pay it. But if I have a computer I use for work, if I were to sell that and make a gain on it, I would have to pay tax on it. But I can do a like-kind exchange, which means you trade like-kind property for other kind of property that's similar, that's like-kind, and you can avoid even paying any tax on it and roll it forward until you sell that asset if you don't do it. We also call it 1031 exchange. That's generally what we call it here in the US for
Yeah.
us CPA gurus, but it's a like-kind exchange. So you can take, it doesn't have to be the exact same property though. So like in the US, I can take raw land that I was eventually planning on building a rental property on, but the economics just didn't work out. And instead of building a property, I decide I want to exchange it into another piece of property that has a house already on it that I can begin renting. They're both real estate properties planned for use in the trader business. I can exchange those. They're like kind enough. But the IRS code says non-US property is not like US property. Meaning, if I wanted to sell a rental property here in the US and upgrade it to a property down in Belize, I would love to come down to Belize. So we should talk more after this recording. But if I
Yeah.
were to do that, I couldn't use like kind exchange because even if it's the exact same model home on the same lot area, it's in a different country. So it has to either be US property for US property, or you can do foreign property. I could do a like kind exchange in Belize for another property in Spain or in Belize. I can do that as long as it's a foreign property for a foreign property and not have to pay any US capital gains tax. You just defer them until you eventually sell that asset or do another 1031.
Perfect. That's great because I have a lot of clients that maybe have bought property in Mexico and they're like, well, I'm not really a fan of this. I want to buy something in Belize. And I don't think a lot of people know about this 1031 exchange. I've talked to many people at real estate conferences and they have never even heard of it, even for their US properties. And that's, I guess, the tax planning piece that the clients I know that know about it are accountants that are real estate investors. So that's kind of one of the reasons we're doing this call is to really help people know what kind of things they need to look at. They don't need to know how to do it, but they need to know that they have to reach out there to their accountant before they sell a property to figure out what they can do to mitigate those taxes, right? Because if you've already sold it, there's timelines for doing these exchanges as well.
Let's talk about that for a second. I want to get into the weeds too much, but that's a huge important concept that we can't over communicate to anyone listening to this. You can't do a like kind exchange if you already sold the property. Most likely. You can never take actual receipt of any proceeds on the sale of a property. You have to do it in the US called through someone called a qualified intermediary, QI. That means they're a fiduciary agent for you, working for you. They have to follow your directions, but they take the cash, they take the proceeds, and then they go give it to the new purchase. You have to do it through a qualified intermediary 99.999% of the time. It's really hard to undo it. So if you are even thinking it's a possibility, make sure you talk to your tax advisor or at least a qualified intermediary before you enter into a contract. If you sign a sales contract as yourself without having a QI, that might eliminate your ability to do it. So make sure you talk to a QI before.
Fantastic. Okay, one other thing I wanted to talk about is the structure of a property. So real estate investment, a lot of people buy it in their own name. That's the simplest way to do it. Some people buy it through a corporation in the country they're buying it in. So, if you're buying a company in Belize, you could set up a Belize corporation to do that. And same thing in the US. I think if you talk to a US attorney, they probably always tell you to buy it in a corporation, where maybe accountants don't say that. So can you maybe talk about and it's different depending on people, of course,
Right.
but in general, if you had a person that had real estate investments in the US and then they have some in Belize, what types of advice would you give them?
So from a tax standpoint, generally it doesn't matter. We use these things called LLCs in the US, which are limited liability companies. And then we have the option to have them either taxed as a corporation or taxed as a partnership. And what we normally tax them as, the third option, that is almost the default option, is they are treated as a disregarded entity for federal tax purposes. The whole reason we use those is because our lawyers push it. It's a liability. It's a liability protection vehicle. And I'll get into that a little bit. I do have to give this disclaimer. I am not an attorney. I'm not qualified to offer legal advice. I'm not allowed to offer legal advice. Always consult with an attorney. But what the attorneys tell our clients, if you own a property in your own name, you're renting it, and let's say you're short-term renting it and you rent it to some college kids and they go get drunk and jump off the roof and break their necks. Unfortunately, we have a lot of ridiculous lawsuits in the US. You could actually get sued for that, and you might find a jury that says you're guilty and it's your fault as the landlord, even though you had nothing to do with that. That happens. That happens way too often. If that were to happen to you and the property's in your own name and your insurance is maxed out, or your insurance says we're not covering this, it's your fault, then they can invade your personal assets. They could take your money from your bank account, your personal money. They could take your personal belongings, your personal car. You could lose all of that if you don't have some kind of liability protection umbrella. So lawyers always say, make sure you have really good insurance, but don't own a business in your own name or a rental property or anything that might get you sued. Own it in a business entity that has liability protection. And 9 times out of 10 with real estate, if it's one person or a married couple working together, they get an LLC at the advice of their attorney. They have it taxed as a disregarded entity, meaning for federal tax, it's all shows up on your personal tax return on the same schedules if you own it personally. But the lawyers say you have that full liability protection. There's a lot of rules you have to listen to your attorney and follow to actually keep that liability protection, not have your protection, your corporate veil pierced, they say, or call it. But that's the number one vehicle we see people owning real estate. It's also, if you have multiple partners getting together to buy real estate, they use LLCs, except now it's not taxed as a disregarded entity, it's taxed as a partnership. And again, what that means is it's a pass-through entity. So even though it's in a corporate entity, that corporation is not going to pay tax on it, or that partnership's not going to pay tax on it. It reports all the income and it says these are the partners who have to own it, and this is their share of income, and they have to report on their tax return. But it doesn't pay income tax. It does pay relatively small franchise tax, depending on what state you set it up in some cases, but it doesn't pay income tax. And then the owners, the partners, get their share of income from that tax return and report it on their own 1040, and then they get all the tax characteristics of it. All the depreciation goes to their tax returns, all the income, whether they owe tax or get a tax benefit, that all happens on their own personal return. In operating in outside the US countries with real estate, it's a very different animal. You could be sued here in the US, depending on how the laws work and what the treaties are between the two countries you're dealing with. More often than not, I see my clients' attorneys recommend they do form an entity here in the US, but generally in Belize, most of our clients have property in Belize, form an entity in Belize as well. And it's weird because their Belizean entity is owned by their US entity. So you have like these two different companies in between you and the property you just bought. But that's all the advice of lawyers. You can buy in the US property in an actual corporation that's taxed as a corporation, it pays tax. Sometimes that's a good idea, but most of the time, the huge predominant amount of the time, that's a bad idea because corporations pay their own tax. They clean up the character of income. So if I have a corporation, it owns a house, renting, the house has tons of depreciation that could really help me on my own tax return. You can't get to it. It gets stuck in that corporation. And that corporation has to pay tax on every dollar of net income it pays. And then if you want money out of that corporation, you have to pay tax when it gives you a dividend. That's income tax or taxable income to you too. So it's double tax.
Wonderful.
Was I on the
Yeah,
right line there or did I digress too
yeah,
much?
that's perfect. That's the thing. The reason I really wanted you to talk about that is we have corporations in Canada, and for tax purposes, we usually tell clients not to put their real estate in it because there's no tax advantage. In fact, just like you said, if you take money out, you pay dividend tax. It's all kind of the same, but we don't have a choice. If we set up a corporation in Canada, it's always taxed as a corporation. You don't have a choice to tax it as personal income or partnership or corporate. So that's why and I've heard people say things where I was like, I don't really understand this US tax. So this has helped me a lot. So thank you very much. And I'm sure other
You bet.
people that'll help them too when they're just thinking about setting up their property. And I would advise people first, if you're buying property in Belize, obviously talk to your US CPA and attorney. But then in Belize, if you want to set up a company, we have lawyers here that specialize in real estate as well. So obviously you need to talk to people on both sides to see what the best option for you is.
Yeah, and I would even throw in there, it's be even better if when you're talking to your corporate attorneys in Belize and your realtor in Belize, you should loop in your US attorney and your US tax person, whether it's CPA or a lawyer or whatever. Have them all working together for you instead of you being the middleman and thinking you heard what they said on one side and translating it, maybe losing in translation to the other guy. You're paying all these people to work for you. Make sure they're working together for you and not against each other.
That's a great idea. And with Zoom meetings like this one, it's very easy to do that.
Yes.
Now, just getting away from real estate, the last thing I really wanted to talk about is the foreign earned income in exclusion. So I have a friend in San Pedro, Belize, who is an attorney, and he lives in Belize, and he talks about how he doesn't pay tax because he's an attorney. So, and I've heard other people say that, but I don't really know too many of the details, and I'm sure some of my viewers that aren't maybe retiring, but they want to move to Belize or elsewhere. How does this work?
Yeah, so it's the foreign earned income exclusion. It can be a beautiful thing, and it is for some people. It has to be earned income. It can't be rental income
Right,
unless you're a real estate professional. But it can't be rental income. It has to be income you're earning. Like it can't be
right,
dividends or bank interest, but earned income. If you qualify, and there's two ways to qualify. Generally, it's being the bona fide resident of a foreign country. You basically have to spend most of your time in that country. And
right.
it gets a little complicated to talk to an accountant, but general rule is if I spend 330 days out of the last 360 days in a foreign country and I earned income in that country, I get an exclusion. It goes up every year for inflation. In 2024, I think it's 126,500, somewhere around there, and it changes each year. But the first 126,500, if that's the right number, that I earn in a foreign country, I don't have to pay any US tax on it. And if you're in countries that aren't going to tax you on it, you get to earn 120 plus grand tax free. You report it, you still have to file tax return, you still have to report it, but you get that exclusion. Let's say you earn 150,000. Okay, well, the first 126.5 is tax free. The remaining amount, you'll pay tax on it. It's a beautiful thing, but it really only applies to people that truly are living in a different country.
All right. Well, I think that's all the questions I have for you. Is there any other things you think that you would tell someone if they were thinking of buying property or moving to Belize that we haven't talked about?
Yeah, there's plenty I could talk about, but I know you have time and I got work to do. But a couple of things I would like to leave with. One, I think, and this is an opinion, not even a professional opinion, because I'm not an investment advisor, I'm just a CPA. I think investing in hard assets offers a great diversification. policy in your own investment portfolio. I am a CPA, but I can't understand our stock market to save our life. Is that money, is the value of the Dow Jones really real, or is it just some made up number because people think it's cool? I think there's good arguments in both ways. I don't trust all my retirement money being in equities. And quite honestly, most of it I don't want in equities because I don't know what the real value is of those. Real estate has a real value. Real estate, except with volcanoes growing Hawaii and stuff, real estate, no one's making any more of it. It is a finite resource that everyone wants and needs. It almost always goes up in value over time. And it's a hard asset. You can go put your feet on it. You can jump on it. You can dig in it. You can feel the soil in your hand on it. That is a real asset that's worth money. So I like the idea of investing in it. Also, investing in real estate versus equities gives you a whole plethora of potential tax benefits. And let's just imagine if you buy an equity that's going to give you a 6% year over year return, or you buy real estate that's going to give you 6%. You would think each of them are equal, but that equity, the stock dividends you're getting, you're not going to be able to peel out any tax benefits. It is what it is. Whatever you get on that 1099 dividend form, that's what you're going to pay taxes on. On real estate, if you can make it tax-free for a number of years, which there's plenty of ways to do, your 6% actually looks more like 8% or 9%. Even though you're saying you're getting the same discount or rate of return from the assets, when you consider the tax advantage, you're getting much better. And then you throw in and wrap in the concept of the time value of money. If you can have an asset, an investment that you get a 2% or 3% kicker because of the tax advantage, and you do that over 10 years, that 2 or 3% turns into 50, 60%. It's a big difference. It's a game changer on building up your financial portfolio, an absolute game changer. And then finally, this is not real estate specific, although I will tell you real estate is one of the greatest areas in the tax code that I just love because there's so many tax savings opportunities. But generally speaking, for anyone, and I don't know about Canadian tax or Belizean tax, Linda, you could add on this, but in the US, the tax code is something you're going to have to deal with, regardless. You can choose to either be a victim of it, just do what you're doing and let the Internal Revenue Code determine how much tax you owe them, or you can choose to take advantage of it and leverage it. And I would highly recommend everyone to rethink tax and realize it can actually be your friend and your partner in what you're trying to do in life versus be the shackles on your legs. It shouldn't be that way. So please consider that.
Wonderful. So, Mike, thank you very much for your time. I will put your contact information in the description of the video. So if anyone does have some tax planning advice needed, I'm sure you'd be happy to help them.
Absolutely. Thank you very much. And also plug our podcast too.
Oh, yes.
Hiddenmoney.com.
Yeah, and we can put that in the description too. So you can send that to me and we'll put that in the description of the video. And thank you very much.
Thank you. And I appreciate you having me on.
I hope you enjoyed this tax information for people buying property in Belize or coming to move here. If you're looking for a buyer's agent, I'd be happy to show you around. And if you need any help with real estate investing, also reach out. Hope to see you soon in Belize.